Hi everybody and welcome to the channel. Months of pent-up travel demand triggered a significant increase in short-term rental markets in many second home hotspots last year. And like everything in a market-driven economy, pendulums swing both ways. Amid the housing crisis driven by the shortage of supply in homes, short-term rental hosts have also felt a massive shift in their passive income. However, Airbnb itself begs to differ, as they released their third quarter 2022 financial report showing it to be their biggest and most profitable quarter. But are Airbnb hosts sharing in the company profits, or is the vacation rental market about to implode and help pull down the greater housing market with it? The reality Airbnb hosts have been experiencing over the past few months has been very different than the company itself. In fact, a Facebook post of an Airbnb host recently went viral. In the post, the superhost said that there has been a huge decline in their Airbnb bookings over 3 to 4 months, with their bookings going from at least 50% to zero within the past couple of months. And their concerns are valid, as short-term rentals tend to weather into a steep decline in bookings as the holiday season approaches. As we all know, seasonality plays an important role in vacation homes and rentals, with the number of guests peaking in the summer. However, this is not the case for superhost Dylan, with an Airbnb home listing in Colorado. He told MarketWatch that there has been a significant decline in bookings of his rental home despite Colorado being one of the major tourist attractions during the ski season. So Dylan was reasonably confused when he went from racking up $60,000 since he started renting his property on Airbnb to zero bookings from November and beyond. According to AirBNB, between July and September, occupancy rates fell in 31 out of the top 50 largest U.S. short-term rental markets, despite the recent gains in new listings in September. The largest gains in new listings in September came from Texas and the Southwest, continuing a trend that began in August. With 43.9% more listings year over year, the Phoenix and Scottsdale market was the fastest growing in the top 50. Houston also racked up 43.2% of increase in short-term rental listings, followed by San Antonio with 42.7% increase and Las Vegas with 36.4% increase in listings. However, rapid supply growth also pushed down occupancy rates in these four markets, all of which saw lower occupancy year over year. Occupancy in Phoenix and Scottsdale fell by 9% and 8% respectively. So if there have been more listings this year, then why are short-term rentals experiencing a strain in occupancy? Well, it's because short-term rentals are oversaturated. Therefore, competition is extremely high, and these short-term rentals also have unrealistic pricing. For example, a map here of active Airbnb properties in Scottsdale, Arizona shows extremely high density with average daily rates of $318 per day. This is a higher rate than other major coastal cities and looks to be an unsustainable market going forward. Jim Ewing, the Airbnb host who posted on Facebook about the lack of recent bookings on his rental home, listed his property in California, and California is a particularly competitive market for rentals due to the glut of investment properties in that area. States like California are very appealing to most investors because, apart from its location and weather, there's also a continuous influx of people moving into the state, and there's a high demand for rental properties. This makes popular states with great supply growth more vulnerable to fluctuating prices and big decline in performance, just like what is happening now. During the pandemic, there was an influx of wealthy homebuyers who overpaid for their second homes in hopes of having a passive income. Back in 2021, investing on a second home was a very appealing idea for many because people were emboldened by low interest rates, extra savings, and ability to work from anywhere. But these white-collar workers seemed to believe the party would last forever. They couldn't imagine the huge spike in interest rates coming or how that would kickstart the overall drop in the housing market. So, there's now an abundance of supply in the short-term rental market, and it's creating tough competition for Airbnb and VRBO hosts. With these market pressures, you would expect people to start bringing the prices down to make their rentals more appealing to guests. But that's not the case here. With the hosts still wanting to milk their return on investment, short-term rental home prices are actually going up. Hosts have failed to realize that people are no longer willing to pay more than $1,000 per night for a 3-bedroom, 2-bathroom house that sits on a small lot. Not to mention, hosts wanting the guests to take out the garbage, clean the dishes, run the laundry, mow the lawns, scrub the toilets, on top of a $200 cleaning fee. Also, remember how Airbnb, the company, reported record profits? Well, there's a reason for that. Airbnb charges additional fees, like a stay fee, a county city fee, taxes. You can either stay at a hotel with 24/7 staff, transparent pricing, standard amenities, and some regulations, or you can pay 30% more and just hope that Superhost Jerry isn't a toilet cam guy and spend the last 6 hours of your trip doing chores of his condo. This month, Airbnb released its third quarter 2022 financial results, and the report went on saying that despite the geopolitical and macroeconomic headwinds, the third quarter of 2022 is still Airbnb's biggest and most profitable quarter. According to the Airbnb co-founder and CEO Brian Chesky, the third quarter of 2022 demonstrates we continue to drive growth and profitability at scale. Guest demand on Airbnb remains strong, our host community continues to grow, and this was our most profitable quarter ever. Well, that's great for Airbnb, but actually pretty terrible for keeping their hosts competitive in a market that has now become oversaturated. The amount of Airbnb listings collecting dust amid the lack of supply in the housing market and the high home buyer demand is baffling. This has contributed to the formation of the housing bubble that's now beginning to pop. The housing exists, but so much of it has been snatched up by institutional investors and wealthy individuals who wanted a passive income and that just refuse to adapt to the current market status. Despite the low occupancy rate in these short-term rentals, hosts are still refusing to bring the prices of the rentals down, while some are still trying to actually raise prices up to maximize their return. However, there are also hosts who can't continue to afford the homes without the income generated by their rentals. These owners are becoming desperate to sell in a market that is very unfriendly to sellers. Others are even looking at turning their short-term rental into a long-term rental. If either of these things happen, it can shorten the gap in between the demand and the supply and will lead to further housing price drops, which we're beginning to see evidence of now and we'll be talking about in future videos. That's it for today's video. Let us know what you think in the comments section below. And if you want to learn more about the current housing market, we have a video laying down all the data about the U.S. housing crash linked down in the description. And please, if you like this video, don't forget to give us a thumbs up, subscribe for more content, and hit the notification bell so that you can be updated whenever we upload new videos. I'll see you on the next one.